Hello, welcome to our webinar today from the Said Business School, University of Oxford. So today we are looking at real estate with a webinar with our Professor of Real Estate, Professor Andrew Baum, and backed up by some of the research which he's carrying out with the Future of Real Estate initiative, and with our guest speaker today, Stephen Ashworth, who Andrew will introduce in full detail in a moment. The webinar today is in support really of our executive education program in real estate, which runs in April each year. So we have 40 professionals from real estate and real estate investment who come along to really take a strategic overview of everything that's happening, the opportunities, the threats, the latest developments, both with our faculty here, with Andrew and some of our other finance professors as well, but also with peers from real estate and investment firms from across the world. So typically we would look to have about 40 people in the group and have people from 15 or 20 different economies on board. The format today is that the webinar will last for about 45 minutes or so. So Andrew will go through some slides with us in a moment and then introduce Stephen Ashworth. That should probably take us up until about 1/2 the hour. We'll then have time for Q&A afterwards. You can ask questions at any time. The way to do that is by using the question box, which is in front of you. So any questions which arise, please type those as you think of them, and then we'll collate them and go through them at the end and address those to Professor Baum and to Stephen Ashworth. Just a housekeeping note, really, you may notice that that your mics are muted. We have almost 100 people online at the moment, so we just mute everybody's mics, so just keep the noise down. But please feel free to use the chat button if you have any issues which you need to raise with us. Do that, and questions as we go on. So without further ado, I'll hand over to Professor Baum to tell us about real estate investment meets alternative finance, the future.
Thank you, Steve. So we at Said, we're running a research program called the Future of Real Estate. We are looking at the impact of innovation and alternative finance and technology on the property market. And we're about to put out our first piece of work on the real estate transaction process, which follows up our first piece of work a couple of years ago on the future of real estate, which some of you may have seen and which you can download from our website. Today we're looking in particular at the opportunity to create an alternative finance market as it affects real estate. And the alternative finance world is characterized by things like crowdfunding, peer-to-peer lending, the use of apps, and more interesting applications of blockchain technology in things like tokenization and ICOs of real estate portfolios. And what we're going to try and address today is the extent to which that alternative finance movement will affect the property market. Our guest, Stephen Ashworth, has been working as a real estate innovator in alternative finance for at least 10 years, and he's got a current proposition which I'll interview him about soon. So as we go on to the second slide, the background to this is that there's clearly been a negative reaction since the global financial crisis, a negative reaction to traditional ways of managing money. And in many ways, fund managers, investment bankers richly deserved negative reaction from the destruction of value that happened in 2007, 2008. And one of the results of that was that investors became unhappy with traditional property funds. The result is that a lot of people have been setting up their own platforms, taking back control. We've seen a decline in the natural supply of investment to traditional property funds as the defined benefit pension scheme has declined and many pension funds are in deficit. We've seen the growth of the gig economy as self-employed employees in tech, media and elsewhere have chosen or have been unable to get jobs, full-time jobs with pensions, and have started to self-invest to think about the future. And that self-investment might well take a different form from the traditional pension fund. You've got increased regulation, which is affecting investment managers everywhere, including property investors. And in the particular property field, you've got charges of money laundering through the London property market, leading to the government asking for unexplained wealth orders alongside all of the other regulation that's going on. There's a technical problem, I think, in the way in which fees are going to be charged in future, because it looks as if the future is not going to deliver such high returns as the past because of reduced inflation, lower bond yields, and therefore, if you're charging a 1% fee on funds under management, 1% of a small return is a big chunk out of the investor's return. And then meanwhile, in the world of equity fund management, you've got Vanguard and BlackRock taking bigger and bigger market shares by producing index trackers on low fees, and there doesn't appear to be any equivalent to that yet in the property market. So there are many, many challenges for real estate fund managers at the moment. Meanwhile, the world of technology has been driving change across the piece. And we've just missed a slide, Steve, so let's go back one. So the result of the global financial crisis is that you've got investors not trusting advisors as they used to do. A lot of the Asian investors that are coming into the London market buying very large assets don't appear to value fund management or asset management advice. They seem to be primarily motivated to get their hands on assets. Syndicators remain in the market, which is again a denial of value for the intermediary fund manager. You know, one of the free lunches in investment is to diversify your risk away, and yet people are choosing to buy shares in buildings and not trusting the fund manager to do that diversification job. And you've got the institutional market increasing its in-house staff, reducing discretion to managers. You've got the local authorities in the UK forming pooling schemes and taking more control back. And you've got the super funds getting bigger and taking on in-house staff, the superannuation funds in Australia, that is. So all in all, the background is challenging for the property market. And then meanwhile, you've got a boom in technology, which is challenging the world of real estate. I don't think we think about the technology challenge as specifically affecting fund management, but that's where we're going to go today with this conversation. What we've seen so far is technology cutting out the middleman, disintermediating the broker. We've seen innovation in property uses, so that we've seen co-working, for example, as a rise as an increasing way of using office space, and we've seen the destruction of the retail sector to some extent to be replaced by logistics. And finally, you've got efficiencies in the use of space, smart buildings, and so on. So how is this technology wave going to affect the world of property investment is the question that we're going to be thinking about. 2008 was a significant year for the global financial market and for the world in general. And what happened in 2008 created the perfect mixture for technology to change the way the property market operated. We had a global financial crisis which was damaging trust between younger people in particular and the traditional advisory world, fund managers, investment bankers. And at the same time, you've got Apple launching the App Store. So the iPhone was launched in 2004, but it really started to take off in 2008 when the App Store was launched. Now, if you imagine a world where you've got billions of rooms in the world and you've got billions of people, and you've got no real way of connecting them. You've got billions of rooms, billions of people, and no way of connecting them. But then Apple launches the App Store, and you've got this perfect formula now. You've got people wanting to cut out the intermediary, and now they're able to cut out the intermediary. So this is the perfect formula for Airbnb. Billions of rooms, billions of people, one app connecting them. And that led to a real boom in prop tech. So we've seen literally thousands of prop tech startups in the last 5 years. One company, Unisu, has a database of over 8,000 prop tech startups, and they're working across the piece. They're working across smart building technology. They're working across shared economy propositions like WeWork, and they're looking at financial technology, fintech markets in real estate. And if we look at the applications for funding through one particular accelerator in London called Pi Labs, the focus, the biggest focus is in real estate fintech, and it's focused on transactions. So we've got literally hundreds of companies that are trying to take a piece of the real estate transaction market, and a tremendous amount of activity applying technology to do that. And the question that is there as a result of that is, what will happen? Will it work? Will it be successful? So if you talk to people in the market, you'll find a lot of evangelists for prop tech, and they will make statements like the first two on this slide. We can expect to see secondary trading platforms that help investors to manage mixed portfolios of listed, unlisted property, particularly at the core end of the market. Well, I would say that's an open question, but it's a question that we'll talk about in a minute. Second large buzz is about blockchain. Blockchain is coming, get ready. If you haven't heard of blockchain yet, it's likely you soon will. It could drastically change the way the real estate industry, if it takes off as proponents believe. It's a new technology, a way of doing business and transformation if it plays out. So we do know that there are people interested in creating platforms that enable more efficient trading of property. And we know that there's this technology called blockchain that is out there that will present an opportunity for people to digitalize their real estate data and connect people together through the transaction process. We also know that there are some things that just don't work very well. A lot of people will say that the conveyancing process, for example, is crying out for improvement, and it's too slow, and solicitors use mail and they don't use technology. And we also know that the capital raising environment for property funds is incredibly inefficient. One speaker on our MBA program, on our exec ed program, last year, Keith Breslauer from Patron logged how many meetings he'd had to raise a $900 million property fund. And he'd logged 497 meetings with investors to raise that capital. It can't be efficient for somebody to have 497 meetings globally, including 20 with Korean investors, when technology exists to be able to communicate. So how big will this tech interruption become? Examples of slightly more, more exotic propositions include propositions like PropCoin, which is a tokenization, an ICO, if you like, an initial coin offering, creating a cryptocurrency whose value is linked to the value of a property portfolio that backs it. We've seen tremendous destruction of value in Bitcoin recently, and whether Bitcoin makes its investors money or loses its investors money, the problem that they are going to suffer is volatility, because there's no fundamental value in Bitcoin. So how do you stop your Bitcoin investment being incredibly volatile? One way is to switch Bitcoin into PropCoin. PropCoin then is used to buy buildings, and theoretically PropCoin's value will connect perfectly to real estate prices, and real estate prices are less volatile than Bitcoin. So will this fund take off? Will Bitcoin speculators start to reverse their gains into property funds? We need to think about the impact of technology. Amara's law is something which we notice over and over again. We tend to overestimate the impact of a new technology in the short run, so we can easily dismiss blockchain as something that won't make much difference in the next few years. But as Amara's law goes on, we underestimate the impact of technology in the long run. So what sort of innovation are we going to see in the 2025 to 2030 period? One scary thought for property fund managers is what would happen if Amazon moved into the property market. So the first thing they would do probably would be to list houses. Yeah. What happens if Amazon starts listing houses? Second thing they might do is listing funds. So what would happen if Amazon became the platform for you to choose your investment portfolio? And then BlackRock and Fidelity would have to list their funds on Amazon. What sort of fees would Amazon cut their commission back down to? What does that mean? So this thing could happen, and where we've got 35% operating margins and Amazon works on less than 1%, then we've got an interesting proposition ahead of us. And then finally, what does this mean for the property market? What sort of innovations are actually going on? At the lowest possible level of innovation, we've seen in the UK a change from open-ended property funds to externally managed REITs. So there has been some evidence in the last 5 years that investors and managers are accepting the benefits of liquidity through a stock exchange, so that the externally managed REIT has gone from the REIT market in the UK has gone from 13 businesses in 2007 to 42 in 2017, not 2107, we're not there yet. So in 2017, and a lot of the new ones are externally managed. So you have a fund manager launching a fund and choosing to list that fund on a stock exchange. So that's innovation, which is not much to do with technology, but it's innovation. We then have a couple of propositions in London right now to create exchanges for buying and selling shares in buildings, one of which is called IPSX. That business is continuing to try to get regulatory approval and to get volume. So will British Land, for example, which is backing IPSX, list its buildings on a stock exchange so that anybody can buy a share in those buildings? Thirdly, as we saw from PropCoin, we've got cryptocurrency property funds leading to the tokenization of property. Now, tokenization is a complex proposition, which I'll ask Stephen to explain to us. But utility tokens were first introduced when we bought software packages. We would have the right to use the software using a token, which gave us access to a website. Now we have utility tokens used in the financial world, but we have security tokens also used in this world, where the token gives you the right to a share in the ownership of a fund. So tokenization is a tech word which is gaining popularity because lots of people like tech. The property world uses the word unitization. Tokenization is a sexy new word for unitization. Will it start to be associated more and more with cryptocurrency funds and ICOs? And then finally, we have seen crowdfunding take off to some extent in the property market. It's limited to smaller properties, less high quality. We've seen peer-to-peer lending. LendInvest employs over 170 people, so you couldn't say that's a small startup. That's starting to make a real dent in the lending market. We're seeing syndicators raising capital, and they're increasingly using apps and ways of communicating directly with their clients, which the traditional fund manager doesn't appear to do. So that's the introduction to the background. We're wondering whether in the year 2020 we'll be connecting thousands of investors with thousands of assets through the medium of apps, and then going on from there to create more technologically advanced property propositions. So in starting to think about that question, I'd like to introduce Stephen Ashworth, who I first met when he was working with a company called Reach AIM Alternative Asset Management, and they were building a very interesting derivative-based property fund that was effectively a property hedge fund offering absolute returns whether property markets were going up or down. Stephen is still involved in innovative property work, and now has a platform called TP Synrex, which is going to think about all of the issues that we've been talking about, in particular launching a platform for the trading of property investment vehicles. So Stephen, if I could introduce you now to the podcast, and would you please explain what it is that you are working on right now?
Yeah, thanks, Andrew. So right now, we are looking at the opportunity to effectively create a digital marketplace for real estate risk. And we think the opportunity here comes out of some of the challenges and opportunities that Andrew's already referred to in terms of the pressures on managers to deliver returns, the pressures on their fees, increasing focus on risk factors within across asset management, and in real estate specifically, the ability to sort of identify which risks you want to take and have an easy and liquid way to access them. And in that sense, the opportunity for tokens on real estate assets is something which lots of people are looking at in the market today, and both across the residential space, but also increasingly in the commercial space. And the technology that's enabling that is the distributed ledger technology behind the blockchain infrastructure, which of course is the technology which drives the cryptocurrencies. So we're looking at basically finding a way to create almost like an industry ecosystem where investors can discover trading opportunities in terms of underlying risks, go through a price discovery process as to where those risks might be tradable, but at the same time and in the same place actually go through a digital execution process for the clearing and settlement of those risks, and create digital ownership registers.
Stephen, sorry to interrupt you, but could we focus on a couple of technical terms there? First of all, could you explain to us where you think the word tokenization comes from and what it means in this particular context? And also then maybe explain to us why you use the word risks rather than buying assets.
So if you look at asset management generally, when you think about constructing a portfolio, the sophistication changes in terms of the way people understand risk and return that have happened over the last 30, 40 years is really at the heart of what's driving people's focus on easy to access risks, aggregating them together in a way that gives them the right mix of return, risk, and correlation between those risks.
Yeah. Okay. So it's building a portfolio that's robust.
Yeah. Now the token concept has really come out of the cryptocurrency world, where the coins that those cryptocurrencies effectively represent are argued to be currencies. In reality, they don't show a lot of features of currencies given their volatility and their lack of usability. But out of that construct has come the concept of a token, which, as you identified, initially started as a utility token for which people were sort of raising money through ICOs. But more recently, there's been a recognition that those tokens can fit within a more regulatory compliance framework, things like KYC, AML, anti-money laundering regulations, and effectively become tradable securities. And so where we are now is that you have a situation where within the sort of the public blockchain world, people are looking at creating security tokens, which really cross the bridge into the regulated world and therefore fall under securities rules as far as the regulators are concerned.
But they're not called securities because of where they come from, or will they always be different from securities?
Well, that's an open question to a degree, and the regulation is a little let's say it's evolving, probably reasonably quickly, but right now you can probably create a token which doesn't fit within the regulatory regime, but equally you can certainly create a token that does.
Okay. So let's envisage the ideal world from your point of view, where TP Synrex is actively facilitating an efficient platform, a market where tokens are traded. What sort of assets would you be trading on the platform?
So in theory, the concept of tokenization can be applied to pretty much any underlying asset you like, and there are actually a number of ways that this can be done, and it's probably fair to say, well, it's right to say that we're quite open-minded about whether actually a full sort of tokenization approach is necessary, or whether there are other ways to achieve digital ownership records. We can go into that in a bit more detail, but just sticking with the concept of the underlying risks that can be traded, you could, for example, take a private real estate group, sort of like an unlisted REIT as they're commonly known in the US market, tokenize the ownership register or the shares, and create tokens on those, so you create tradability, where today in an unlisted REIT structure you wouldn't have that tradability. You could then go across to sort of an open or indeed a closed-ended fund and tokenize those fund units. And then you could go a step further and actually say, well, maybe we can consider tokenizing physical assets themselves. And you mentioned in your slides earlier the IPSS exchange. Their construct is to do something very similar, but going all the way across to the fully currently regulated equity market and actually creating an equity market exchange for those risks to trade. So in a way, tokens sort of sit halfway between sort of the unlisted private investment world and the full listed securities world.
Yeah. Okay. And could you explain the relevance then of blockchain to this process? I mean, a lot of people will wonder what blockchain is. You've talked about the distributed ledger technology. If you created this platform, would blockchain have to be underneath it?
So blockchain is a generic term to describe the computer coding technology that sits behind the cryptocurrencies, and in essence, that technology is essentially a distributed ledger technology. So what does that actually mean? Basically, it is a multiple access sort of read-write database with with different permissions that give different people different rights to do different things. And that can be, in the case of blockchain itself, that is a completely sort of open architecture platform that is public. The actual blocks on that ledger are publicly accessible, although obviously you can't. It's all encrypted, so you can only access the information which your private key allows you to access. But there are a number of ways in which you could use that technology within real estate, and again, this is an open and evolving area. There are some groups out there which are following the public sort of blockchain type route. We tend to think that actually a private distributed ledger technology might be more relevant and readily adoptable in the near term, certainly by institutional investors in the real estate world.
Okay, we could get quite technical about this, and we probably have to at some point, unfortunately, but what is it that distinguishes blockchain-driven tokenization from the traditional way in which, for example, I'd hold units in an open-ended property fund? If I own a unit in a property fund, I have some ownership of something, I have a certificate from the fund manager of some sort. Why is that not useful in what you're proposing? What's the significant difference between that and tokenization and your blockchain platform?
So that's a very interesting question, and one that we've actually been asking ourselves in many ways over the last few months, because actually the digital representation of ownership is something which people are comfortable and familiar with today. If you hold, if you're a retail investor, hold funds in one of the fund supermarket platforms, for example, you hold you've almost got a digital register of your risk. A central clearinghouse such as Euroclear or Crest for equities, in many ways that is a digital representation of your risk. So why do you need the technology? Well, the technology really changes the way in which the whole data set is stored. It changes the way it's accessed and shared, and it changes the way that people interact with it. And through that, there are opportunities. There are also some challenges, but in a sense that your ownership of a fund is held directly by that fund itself, and you access that. If they could in theory put that fund register, and this is actually something that we're looking at, in a digital format, and make that tradable within a private distributed ledger technology. So from your perspective, you really wouldn't see much different, other than the fact that your ability to execute is much improved, and you should have a much better liquidity in terms of accessing. Because at the moment, you have to go directly to that one manager to either redeem or subscribe for units.
Yeah. So whatever, I can see that the blockchain technology and the tokenization concept enables you to jump over a lot of traditional back office processes that would otherwise have to be redesigned for the world that we would like to move to. But this helps you to jump, I think, that generation. If we get to that world, what exactly has to happen to create the volume in your platform? You know, in order that I do get liquidity in my investments, I need somebody on the other end of the system, don't I? So who's going to be there, and how do you get them to join this platform?
That's right. So maybe, you know, for the wider context, let's just step back a bit from there. And you know, if you look at the businesses that are out there today, quite a lot of them are involved in using the public blockchain and public token protocols. So within the world of Ethereum, which is one of the cryptocurrencies, there is a token called an ST20 token, and there are groups trying to make that a standard. And their logic to create liquidity is to say that because they're making a bet effectively that this the Ethereum coin structure, the ST20 token, in theory, if there are sufficient people around the world who adopt that, then the intertradability of that comes through that sort of wide scale, sort of ground up adoption of that technology and that protocol. The alternative is to create a private distributed ledger ecosystem, which is more about pooling industry's interests. And in some ways, again, in terms of the near term, we think that has quite a few more positives and less challenges. But to make that happen, you have to have critical mass of the industry involved at a relatively early stage in the process.
Okay, so to make that work, you probably need to get a consortium together of leading investment managers to agree that this is the protocol they're going to use to create a sort of a secondary trading platform.
That's right. Absolutely, and it's not just about a secondary trading platform. It's actually it's an issue. You know, there's a lot of value here in terms of the issuance. It's a new route to investors. You know, one of the types of investors that might be interested in this sort of approach, and you mentioned it again on one of your slides, is the balance between sort of defined benefit and defined contribution pension markets. And there's a big mismatch today, as I'm sure you know, between the allocation to real estate within the defined benefits markets and the defined contribution market, with the defined contribution market being significantly under invested compared to sort of recommended benchmark allocations.
If we were in this world, Stephen, where I could go onto a platform like this and I could choose to buy a share in a building or a share in a property fund or a share in a REIT, who's going to advise me about the right thing to do? And you know, is there any intermediary system of protection, investor protection, or is this a sort of direct to retail proposition, do you think?
So it certainly could be a direct to retail proposition, you know, and actually, and again, you know, if you look at the businesses which are out there today, many of them are seeking to do that. They're seeking to go direct to retail. Actually, we think that the institutional route is the better route to get scale of liquidity, and there's certainly a role for advisors to be plugged into that platform and infrastructure as well. And ultimately, you know, there are a number of key themes that this sort of environment has to address. It's really about standardization. It's about liquidity, but it's also about transparency. So there has to be transparency of the underlying risks into the assets that you are effectively investing in. So you know, that information should be available just as it is today in terms of processes, but it's available in a central location.
One of the things I'd be worried about, Stephen, I think, is I'm a good old-fashioned property investment advisor, and I put my clients' money into some unlisted property funds that don't move in value very fast. They throw off a nice 4.5% income yield, and every year the valuation goes up by 1%, or maybe down by 1%, or maybe up by 2 or 3%. And now I'm contemplating putting my assets onto your platform and trading through your platform alongside REITs, which are daily traded and have got volatility in their pricing. Aren't we going to move from a world where property is a nice, safe, low-risk asset class to something which is now volatile and moving around all over the place?
Well, there's probably a little line there, isn't there? A little bit along the line of risk and return. You know, if you have an illiquid investment that doesn't trade, and then you only see what its pricing is once every 3 months, and actually over the long term the asset performs, then you see a nice, very low volatile asset. And that may be great as far as your allocation models are concerned, but is it actually a representation of the truth? And there will, by definition, if you make something more tradable, it will be more volatile. I guess the question really is whether in actual fact that extra liquidity, which should benefit the whole market, whether that extra volatility is the price you're prepared to pay for that extra liquidity. If at the end of the day it isn't, well then, you know, I guess you stick with your sort of unlisted and hard to trade risks. But actually, if you sit down and you realize that actually those risks it's probably a false representation to say that they have as low a volatility as they do, then actually having that extra liquidity is a good thing. One other point that I would make here, and it's been very clear over the sort of last 15-20 years that I've been looking at sort of real estate risk, that the industry is very siloed in its approach. So the world of equities occupies a slightly strange place out there in a silo, which actually in some ways explains why it is particularly more volatile. You know, an equity wrapper is and the equity instrument itself is traded by many more people other than pure real estate investors. And a lot of the volatility that comes into the sort of listed real estate names, sort of the Landsec's and the British Land, for example, is driven by investment groups that are not necessarily looking through to the underlying real estate.
What I can understand, noise traders, Stephen.
Noise traders. So one of the classic examples is linking into the rise of the tracker fund. If you are a FTSE tracker fund, then every quarter when you do your rebalancing for the weights, then you clearly have to buy or sell REIT names in line with their performance. So what does that mean? That means that if they've outperformed the market, you increase your weight to them. If they've underperformed the market, you decrease your weight to them. Now, you know, in a world where you've sort of got mean reversion in terms of premiums and discounts to value, then those moves are overemphasized. So the idea of coming back to sort of a real estate ecosystem where you have tokens that trade, they are real estate risks. Actually, I think we would argue that they should not be as volatile as the world of equities. They may be more volatile than what investors currently perceive today, but that extra liquidity is a worthwhile benefit.
Yeah. Okay, thank you. We've got a related question to that. It's quite a long one, but I'll just read it out word for word. In the primary issue of a token of a fund, could one break the token into one asset in that fund, i.e. 50 diverse buildings in the fund on which tokens are issued? I then buy tokens, but after 1 year, I want to adjust my exposure and sell out of the office part only and keep my retail. So can I therefore split my token by asset class or even by individual building level?
It's an easy one for you, Stephen.
Do you get that?
Kind of. So I think what they're saying is, if you take a portfolio and tokenize it, then you know, can I then at a more granular level than the portfolio trade out of one part of that risk? Yeah.
Correct. So you want to sell out of the office and keep the retail in this case.
Yeah. So I guess the question there, or I guess the answer there is going to be a function of how you create those tokens in the first place. So if you were to tokenize the assets by perhaps by industry type, initially, then certainly that would be possible. If you were to tokenize them by building and aggregate them together, that would be possible as well. If you tokenize the whole portfolio, then that would not be possible. So it's a question of where the granularity of the tokenization comes from.
One particular use I can see for that idea, Stephen, and the questioner is if you had, for example, to create a pan-European property fund and you were mixing UK with Euro exposure, it may be that some investors would prefer not to have the UK exposure and some would want UK exposure. So you would, presumably you could split the property fund into a UK token, a continental Europe, Euro token, or one, or both.
Absolutely.
Which investment fund managers at the moment don't really have that facility. It's very hard to create a property fund with sub funds that you can invest in, but this is a neat route to doing that, isn't it?
Absolutely right. And my personal and our personal approach to this whole challenge and why we're thinking about this is because we believe strongly in liquidity, but we also believe strongly in risk management, and the tools that are available to investors have historically been lacking for risk management.
So does this world lead you down the road of derivatives, Stephen, so you can go short?
So, well, of course, as you know, Andrew, that's kind of where we started our journey from, and the world of property derivatives has a lot of history. Not all of it necessarily deemed by the industry to be good, but our experience and my personal experience from trading these instruments is that they introduce an amazing flexibility and power for sort of top-down risk management, value creation through arbitrage, looking at the difference between public and private sector valuations. So ultimately, the more flexibility you have, then the more ability you have to create these tools and instruments. And perhaps, absolutely, there's no reason why, if a security is deemed to be a token, then you can't have a product that actually allows you to go short it.
Right.
Okay. Thank you. So another question is coming. Traditionally, real estate forms less than 30% of investment in a portfolio. Given tokenization, do you see this trend shifting, and in what direction?
Sorry. What was the quantum there of the allocation?
30%.
Traditionally, it forms less than 30%.
Yes.
I think that's actually a very high number. I mean, if you look at the defined benefit schemes, traditionally real estate is about a 10% allocation there. If you look at the defined contribution schemes currently, I think it's about a 3% allocation. So 30% is actually a very high number, actually. I mean, okay. Our perspective is thinking about like raising the allocation from 3 closer to 10. I'm not sure that getting to 30% is. I think that's very high.
Okay. We have a range of questions around market readiness and market growth, if you like. So one is around region and the different areas. Do you think that the market is ready for this concept, and is it particularly attractive in any particular region which you can think of?
So if we look at what different businesses are doing, and actually the US is clearly active in this space. The UK is reasonably active, and actually there's quite a lot happening in Germany here. The focus seems to be very much towards the retail investor. You've got historical groups in the UK, for example, like Property Partner, and there's a business called British Pearl, which effectively, without using distributed ledger technology, give investors the ability to access sort of individual buildings. And so there are various states of evolution of this in different markets. The one area that I think is not active at the moment, and clearly we would want to see it more active, and we'd like to see it more active, and we're trying to encourage that, is the institutions themselves being involved. So at the moment, the businesses that are active, and there's plenty of groups that listeners can sort of look at and even invest with today. They are but they're very much focused on residential risks. And the institutional side of things and the focus on commercial risks is we think where the opportunity lies.
Okay, thank you. Question as well, again, about market take-up. So saying that, do you envisage that tokenization can bring on board the millennial markets into real estate investment, I guess, in more of a retail type way? So at the moment, if it's primarily being driven by sophisticated investors, do you see the rise of more retail crowdfunding and platforms where the millennials might be able to get on board with quite easily?
Well, I think that's exactly that is exactly what's out there today. A lot of these businesses are focused on that type of audience, certainly, as Andrew said, where these workers are part of the gig economy, they don't have traditional pension structures. The democratization of real estate is an often used phrase in the concept of this whole space, which is about basically allowing the retail investor access to risk exposures that traditionally have been the preserve of the institutions. So there are platforms out there that would let you or I, or millennials, for very small outlays into their platforms and businesses, to buy into sort of healthcare development sites in Miami, for example. And that kind of thing is incredibly powerful.
How about, Stephen? I'm sitting next to Lizzie, one of our researchers, and she's desperately trying to buy a house in Oxford at the moment, but she hasn't got enough money to buy one, I don't think. So can you see this ever leading to a utility oblique security token system whereby people can buy a small share of a house that gives them the right to occupation?
So again, there are businesses out there that do that. So there's a business called HIP Property, and that's exactly what it does. And it has an FCA license. It's ICO funded, and it allows people to not only buy into residential exposures with smaller pieces, but it actually also allows people to take the properties that they own and fractionalize them out such that they could sell out some of the equity to other people on that platform. Now, so that's absolutely possible today. Now it's probably relatively early days for for that construct. I guess I might caveat that by sort of question whether there can ever be a sufficiently large market for those kind of risks. And I'm not sure I know the answer, but there are businesses out there that do that today. And certainly, on paper, it's a very powerful concept. But, is it ever going to be sufficiently liquid? I don't know.
Okay, we're coming up on time, so just got we've got a few more questions, but I think hopefully we've covered most of them in Andrew's questions and generally. One specific one here around the Islamic market and the potential to attract huge funds from the Muslim market. Do you think there's any ideas to design something purely in an Islamic compliant way that could be attractive to those markets?
So I am familiar notionally with the sort of Sharia compliant rules of that marketplace, but I have to say that I'm not. I'm going to have to say I can't answer that because I'm not sufficiently familiar with exactly what the rules
are. I think the question was implying that this sort of system makes it much easier to be Sharia compliant, and it actually offers a route to that compliance.
Okay.
So there is no doubt that the extra flexibility around the storage of the data, how it's moved around and how people interact with it should help with that as a fundamental point. But again, I'm not sure I'm sufficiently familiar to know whether that it can be done very easily or not.
Okay. A final comment from Derek. Could you please say the name of the platform which you just mentioned again, please?
So HIP Property, HIP.property. Type that into Google and it pops up. Now, I'm not advocating it. I'm just reporting that it's out there. You know, we've done quite a lot of work looking at different businesses and groups.
Yeah.
That's what it does. What the website says it does. I wouldn't want to. I'm not sure I would be ready.
Not recommending it, but we are just saying it's out there. Andrew, do you have any more questions for Stephen, please, before we leave him?
No, just to remind everybody that Stephen's business is called TP Synrex, SYNREX, and Stephen, we look forward to having more conversations and seeing how you progress.
Well, thank you very much, Andrew, and appreciate your inviting me on to this panel. It's a fascinating area, and there's a lot of there's going to be a lot happening in this space over the next 5 to 10 years.
Great, thank you very much, Stephen.
Thanks, Stephen. We'll speak soon. So to close off our session today then, I just want to give a 2-minute overview of our executive education program in the area of real estate. So this is a 5-day program which runs in April each year. The idea is that this is for people who are already experienced and qualified in real estate. As I said at the top of the webinar, we would aim to have 40 people in the room. On average, we're looking for people with 15-20 years experience, and to have people from around 20 different countries. During those 5 days, you will work with your peers across the group, really to understand the kind of strategic opportunities and threats happening on the real estate market from all sides at the moment. So from the user markets, from the development markets, from the capital markets, what's happening in technology, some of the areas which we've touched on today. We will also then put you into groups to work on a proposition of your own, or one of the members of your group. So an excellent opportunity to work with people around the table who you might normally be across the table from, and to really work on your own strategy and ideas with peers from across the world and from investors. So this is aimed at people who, as we say, are already experienced, probably in real estate already, although we do sometimes have people like lawyers who have recently moved into a real estate function. We'll have real estate owners. This is what a group typically looks like. So within this group, I won't mention any particular individuals, but we have people from British land and from other large British landowners, from some of the world's largest institutional investors, some family businesses, and developers from across the world, really, some developing new cities, new business models, such as what we've talked about today with tokenization, but also affordable housing in developing countries, and new models across the piece. So these are some of the people who have joined us and sponsored the program over recent years. The program runs in April. You can apply online. We will send you the link to that after this webinar. We will also include the slides from today as well. That was one of the questions which we had. So just to reiterate, we will circulate the slides probably tomorrow. And if you have any questions, either regarding those or regarding next steps in applying for the program in April, please respond to that email and we'll get straight back to you. So really just for me to say thank you to Stephen, if he's still out there, but also to Professor Andrew Baum for chairing today and leading, and to thank you all for coming along and joining. We've got over 100 people online, which is a fantastic turnout for us. So thank you very much. We will record this, so we will send you a link. Please share it to your friends and hope to see you in Oxford soon. Thank you. Bye-bye.